Welcome back to the deep dive. Today we're cracking the code on how the biggest money managers actually build their portfolios. We're not talking about just guessing what stock to buy next. This is about highly sophisticated portfolio architecture.
It is, and we have a fascinating roadmap in front of us. It's a recent SEC 13F filing from Wealth Enhancement Advisory Services, LLC. And, these public disclosures, they often reveal so much more than just holdings. They show strategic intent.
Exactly. And that's our mission today. We want to unpack a major allocation move they made and really understand what it tells us about accessing a traditionally high-risk, high-reward part of the market. We're talking about small and mid-cap stocks. We want to know why they chose this particular tool to solve the persistent institutional dilemma, right? How to find growth without getting hammered by excessive volatility.
Well, let's start with the specifics because the transaction that caught our eye was Wealth Enhancement, significantly increasing its position in an ETF. It's the VictoryShares US Small Mid-Cap Value Momentum ETF, or the ticker is USVM.
And this wasn't just, rounding up a small position. They boosted their holdings by a massive 618,272 shares. And critically, that pushed the exposure up to a full 1.125% of their total reported 13F assets under management as of the end of 2025.
And that 1.125% figure, that's crucial. In institutional terms, a position of that size, it signals a core strategic commitment.
So it's not just a fly-by-night trade.
Not at all. This position is large enough to sit comfortably next to their heavy hitters. Funds tracking big indices like the IVV for the S&P 500 or bond funds like AGG. This isn't just passive exposure. It's a deliberate capital commitment toward systematic, factor-driven equity strategies.
So they've basically identified a specific weakness in a standard portfolio, the need for controlled small-cap exposure, and they've used a highly specialized tool to fill that void.
That's it, exactly.
Okay, let's unpack that specialized tool then, USVM. If an institutional advisor is deploying this much capital, they aren't just looking for simple exposure. We know the core mandate is to capture U.S. small and mid-cap performance. But what makes this ETF different from, the dozens of other small-cap funds out there?
Well, the differentiator is the factor-based lens. They are screening the entire universe not just by company size, but by two very specific attributes that have historically been shown to drive returns. And those are value and momentum.
Value and momentum, a combination strategy.
Yes, seeking companies that are fundamentally cheap and showing recent strength.
Okay, when we talk about factors, we really can't afford to be vague here. We know momentum generally means, winners keep winning, showing sustained price strength. But for a sophisticated index like this one, are we talking about a simple 12-month trailing return? Or is it more complex, like maybe a volatility-adjusted momentum metric?
Yeah.
What are the typical look-back periods?
That's a great question, and it really speaks to the institutional precision we're decoding here. While the precise proprietary methodology is always a bit of a black box, these systematic funds typically use a multi-pronged definition of momentum. They often weigh various look-back periods, say 3, 6, and 12 months, to smooth out the noise and avoid getting whipsawed by a brief spike.
Okay, so it's more stable.
And more importantly, they're often risk-adjusted. Which means the strategy screens for securities that have delivered high returns relative to their own internal volatility. It's momentum, but with a seatbelt on.
Momentum with a seatbelt. I like that. So they aren't just chasing the hottest, fastest moving stock. And then you combine that with value. We know value looks for stocks trading cheaply relative to their fundamentals, like book value or earnings.
Right. And value, very often, is the reliable counterpoint to momentum. Momentum focuses on price action. Value focuses on financial structure.
So they're almost opposites in a way.
They can be. And the critical thing USVM does is blend them. You're not just isolating companies that have been beaten down, which is pure value, or companies that are potentially overheated, which is pure momentum. You are looking for companies that are cheap but are starting to show signs of life. That initial uptick that suggests a turnaround is gaining real traction.
That sounds incredibly powerful, but also, difficult to implement systematically. How does USVM actually build its portfolio? Is it just picking the top 10% of stocks from the Russell universe based on a blended score or something?
Not quite. The source index is the MSCI USA Small Cap Index, which is a very broad universe. But the crucial step is the rules-based screen. This screen is like the engine's programming. It systematically selects stocks based on their combined value and momentum scores.
So it completely ignores the traditional cap-weighted approach.
Precisely. If it were cap-weighted, the largest companies in the small cap universe would just dominate the fund, regardless of their factor profile. By using a rules-based screen, USVM can overweight the factors it believes matter most. And this screen also integrates some crucial structural guardrails, which are vital for institutional use.
What kind of guardrails are we talking about?
Things like liquidity filters, ensuring they can actually trade the stock without moving the price and sector, and concentration limits, which prevent the fund from becoming overexposed to a single high-flying sector.
Okay, we've established the architecture. This brings us to Section 2, the institutional rationale. Why choose this complex blend over just a standard low-cost ETF that tracks the Russell 2000? Or, for that matter, why not just buy a pure low-volatility ETF? The critique says the main goal here is managing risk more carefully.
And that's the critical institutional insight. Professional allocators, they are paid to deliver predictable outcomes across different economic cycles. They know that small cap investing is a roller coaster. You might get fantastic 30% returns one year, only to suffer a 40% drawdown the next. USVM is designed specifically to reduce that volatility profile compared to those raw, cap-weighted benchmarks.
So if the Russell 2000 is the wild stallion of the market, USVM is the well-trained racehorse. But how does blending value and momentum actively achieve this volatility reduction? They are often considered higher return factors, not necessarily low volatility ones.
That's where the blending acts as a sort of stabilizer. Think of factors like different types of fuel. Value performs best when the market is focused on fundamentals and recovery, often later in the economic cycle. Momentum, on the other hand, often performs best during strong market trends and growth cycles.
So they don't always work at the same time.
Really. When you blend them, you are ensuring the portfolio isn't solely reliant on one style being in favor. If value is struggling, as it has in recent periods dominated by large cap growth, momentum can provide performance ballast, and vice versa.
So the volatility guardrails aren't just some arbitrary limits. They are the result of this disciplined, counterbalancing approach to factor selection. It's managing the risk of being wrong about the market cycle.
Exactly. And the structural guardrails ensure consistency. Small cap strategies often become overly concentrated in highly speculative, illiquid names during market peaks. By applying strict rules, which might limit single stock exposure or require minimum liquidity, the fund tempers that tendency to chase the extremes. This is the institutional answer to accessing smaller company growth without fully embracing the inherent extremes that define the small cap category.
This makes the allocation by Wealth Enhancement a deliberate role within their extensive, diversified portfolio. It's not a short-term trade aiming for the highest possible return. It's a systematic position aiming for controlled, factor-driven outperformance over a full cycle.
Right. The positioning is selective rather than expansive and rules-based rather than thematic. To use an analogy, imagine building a championship sports team. Pure value is your reliable, experienced veteran. They might not score the most flashy points, but they are predictable and fundamental. Pure momentum is your hotshot rookie incredible upside, but highly volatile and prone to streakiness.
Okay.
USVM is the sophisticated coach. They aren't just putting the veteran and the rookie on the floor. They are designing plays that utilize the strengths of both players simultaneously, but they have a strict, minute limit on the rookie to manage risk.
That really clarifies the trade-off. You are paying for management and structure, not just a pool of stocks. So what does this all mean for you, the listener? The focus here shifts from raw return prediction to understanding behavior.
The real relevance lies in observing how this engineered product performs when the market environment shifts radically. We want to know its performance relative to plain small-cap benchmarks during steep drawdowns. That's when the volatility guardrails really earn their keep and during sharp recoveries. Does the systematic approach sacrifice too much upside in the name of safety? That's the key question.
Let's look at the hard data then. That gives us the context for their decision. We have a snapshot from early January 2026. The fund is substantial, with assets under management clocking in at $1.18 billion.
That AUM figure alone shows significant market acceptance for this structured approach. And looking at the operational data, the price point as of January 7, 2026 was $93.81, with a decent trailing dividend yield of about 1.8%.
Now for the key performance metric. Over the past year, USVM delivered a 13.52% total return. That sounds solid on the surface, but we have to look deeper into what the market was doing.
Indeed. This is where the context becomes everything. The source material notes that this 13.52% return actually underperformed the S&P 500 by 2.96 percentage points over that same year. In a simple vacuum, that looks like a failure.
Right. If the S&P 500 returned over 16% in that period, And this specialized small cap blend only returned 13.5%. Why would a professional allocator commit such a massive chunk of AUM to it? That seems counterintuitive.
It raises the most important question for any factor strategy. What was driving the market? The period leading up to this filing was, well, it was characterized by robust performance in large cap growth stocks, the Magnificent Seven dominating the S&P 500. During those regimes, value tends to struggle, and pure play small cap indexes are often overshadowed by large cap returns.
So the underperformance relative to the S&P 500 isn't the fund failing its mandate. It's the fund performing exactly as you'd expect, given the market environment favored the absolute biggest stocks.
Precisely. If we connect this back to the bigger picture, the mandate here is not to beat the S&P 500. It is to capture superior returns within the small cap segment while reducing the associated downside risk. The fact that they still captured double-digit returns while managing factor exposure and volatility in a large cap dominant year likely validates the strategy for wealth enhancement.
Interesting. So they're not using it as a core large cap replacement.
Absolutely not. They are buying the fund for its specific risk-adjusted exposure to smaller companies.
So they're prioritizing the controlled, systematic access to these high return factors over chasing raw, short-term returns that would inevitably come with much higher volatility. It's a risk budget decision.
Absolutely. The investment philosophy itself backs this up. High value and momentum factors are the goal, but the filter is lower volatility and moderate turnover. They are seeking efficiency and stability, not just high-octane performance. The allocation signals that Wealth Enhancement believes this structure provides the most durable, long-term way to play the small-cap field.
This deep dive has revealed far more than just a purchase then. We've seen sophisticated asset allocation in action. This firm isn't choosing stocks. They're choosing financial engineering. They're using these highly customized, rules-based financial products like USVM to achieve two goals simultaneously.
And those dual goals are non-negotiable for them. Specific market exposure to the growth potential of the small mid-cap segment, coupled with explicit risk control through those built-in factor screens and volatility guardrails.
It really proves that factor indexing has moved from academic theory to the bedrock of institutional portfolio construction.
It really has.
So for you, the learner who wants to understand the professional viewpoint, here is a final provocative thought that builds on what we've discussed.
We've established that USVM's strength lies in blending two factors, value and momentum, to sit safely between traditional small-cap risk and aggressive single-factor bets. Now, consider the inherent tension. Value and momentum are often divergent, meaning they're rarely strong at the same time. Given that the index is forced to use both, how does this systematic blending strategy perform during a sharp V-shaped market recovery, where momentum might be spiking, versus a long, grinding recessionary recovery where value slowly begins to outperform? Does the rule-based approach of combining them inherently dampen the explosive returns of the preferred factor during any given market cycle, or does it deliver smoother, superior risk-adjusted returns? That tension is the hidden cost and benefit wealth enhancement is betting on.